Stop and think about it for a moment. Today, buying a house in America means walking into a bank, signing a thick stack of documents, and committing to pay that loan back over 3 decades. 30 years. That's long enough to raise a child from infancy into adulthood. Yet we barely blink at it. We treat the 30-year fixed-rate mortgage as though it were a fact of nature, as permanent as gravity or compound interest, something woven into the fabric of American life since the beginning.
But it isn't ancient at all. The 30-year mortgage, in the form we recognize today, only came into being starting in 1934. Before that point, purchasing a home in the United States was an entirely different and far more brutal undertaking. It was riskier, harder to access, and largely reserved for people who already had money. For most of the country's history, owning a home wasn't a right or even a realistic goal for the average worker. It was a privilege that belonged almost exclusively to the wealthy. So how, before the 30-year loan existed, did Americans manage to buy homes at all? And what had to collapse so completely that the federal government was forced to step in and rebuild, from scratch, the entire way the nation financed shelter?
To answer that, we have to rewind to an era before banks were even in the business of issuing home loans. The story of American housing finance is really a story about power, about who was allowed to own land, who was shut out, and about a handful of financial inventions that physically reshaped the country. Land before lending. In the young republic's earliest years, owning land had nothing to do with banks or monthly payments. It was a question of what the federal government would do with the staggering amount of territory it controlled after the Revolutionary War, land stretching west into regions most Americans had never laid eyes on. Deciding how to distribute it became one of the most heated political fights of the period. The Land Ordinance of 1785 was the government's first serious attempt to bring order to the process. It carved public land into townships 6 miles square, each split into 36 sections of 640 acres apiece. As a surveying system, it was remarkably tidy, but the parcels were too large and too expensive for ordinary settlers to afford. By 1800, the government had trimmed the minimum purchase down to 320 acres and allowed buyers to pay in 4 installments, but the price still sat at a fixed $1.25 an acre, and buyers still had to commit to a huge tract. For a working family, that was essentially an impossible sum. This system wasn't built with the common laborer in mind. It favored speculators and investors with the capital to buy in bulk and resell smaller pieces at a profit. For decades, the main route to land ownership for regular Americans wasn't a bank loan. It was raw physical effort. Families squatted on unclaimed ground, threw up a cabin, cleared trees, planted whatever they could, and hoped that once surveyors eventually arrived, their claim would be recognized. It was informal, risky, and legally shaky, but for millions, it was the only door open to them.
Then, in 1862, everything shifted. In the midst of the Civil War, with the Southern lawmakers who had long blocked such a bill now absent from Congress, President Abraham Lincoln signed the Homestead Act into law, arguably one of the most consequential laws in American history. The offer was straightforward. Any adult citizen, or anyone who had filed intent to become one, could claim as much as 160 acres of public land, live there, work the land, improve it, and stay for 5 years, and the property became theirs outright for a filing fee of roughly $10.
The scale of what followed is hard to overstate. Between 1862 and 1976, the Homestead Act handed out more than 270 million acres across 30 states, about a tenth of the entire land area of the United States moving from public to private hands. Over 2.3 million claims were filed, and more than 900,000 land patents were ultimately issued. Vast stretches of the Great Plains in the West were converted from open prairie into a quilt of family farms and small towns. not through clever financial engineering, but through sheer endurance and the willingness to break frozen soil. There was, however, a major limitation. The Homestead Act was built for rural, agricultural land. It did nothing to help people buy homes in the booming industrial cities of the East and Midwest. As factories drew millions into places like New York, Boston, Philadelphia, Cleveland, and Chicago, those new city dwellers weren't looking for 160 acres. They wanted a small lot, maybe a row house. And for them, financing a home was a completely different problem.
Cash, or a trap called the balloon payment. In the cities, would-be buyers essentially had two choices. The first was simple and exclusive: pay the full price in cash with no debt at all, an option available to almost nobody. In the early 1900s, lenders commonly expected buyers to put down 50% of a home's value before financing was even discussed. Picture a modest home priced at $4,000, a fair figure for a working-class house at the turn of the century. That meant scraping together $2,000 up front. With the average American worker earning somewhere between $400 and $500 a year at the time, saving that down payment meant putting aside every single cent of income for 4 or 5 straight years. No food, no rent, nothing. For most families, it simply couldn't be done. The second option was something loosely called a mortgage, though it looked nothing like today's product. A borrower might approach a savings and loan association, a local bank, or an insurance company, and, if approved, receive a loan covering perhaps 50 to 60% of the home's value, still leaving a massive down payment to cover. The loan term itself typically ran just 3 to 5 years, occasionally stretching to 10. And critically, none of those payments touched the principal. Borrowers paid interest only, month after month, without ever shrinking what they owed. When the short term ended, the entire original loan amount came due immediately in a single lump sum, the infamous balloon payment. The name fit grimly well. Families could make every interest payment on time for years, build a life in the house, raise children there, and then find themselves suddenly on the hook for the full original loan amount, all at once. Some managed it through savings, rising property values, or refinancing. But enormous numbers of borrowers simply didn't have the money when the balloon came due, couldn't refinance, and lost their homes. Default rates on these loans were high, and ownership became a revolving door rather than something stable. Less like owning a home and more like renting the illusion of ownership under a constant countdown. The building and loan movement. One kind of institution did try to make homeownership more attainable for ordinary workers, and it predated any federal involvement by a century. These were building and loan associations. The first, the Oxford Provident Building Association, was formed in 1831 in Frankfort, Pennsylvania. The model was elegantly simple. A group of working people pooled their savings by buying shares in the association, and as that shared pool grew, members took turns borrowing from it to build or purchase homes. Once one member's loan was paid off, the next person in line got their turn.
If that setup sounds familiar, it should. The most famous building and loan in American pop culture is fictional. The Bailey Brothers Building and Loan from the 1946 film It's a Wonderful Life. The story resonated because it reflected something true. For a century, these institutions were the backbone of working-class home ownership, standing between ordinary families and an otherwise indifferent banking system. Even so, home ownership stayed stubbornly limited. By 1900, fewer than half of American households owned their homes. The rate sat around 46.5%, and it actually drifted downward between 1900 and 1920. That wasn't only about credit access. It also reflected explosive urban growth. As immigrants and rural migrants flooded into industrial cities, housing costs climbed faster than wages could keep pace, and tenements, boarding houses, and cramped rentals became the norm. For many, owning a home was simply out of reach.
The Roaring '20s and the crash. Then came the 1920s, when the housing market inflated right alongside the stock market. A strong economy, rising incomes, loose credit, and widespread optimism combined into a housing bubble that, in retrospect, was heading straight for disaster. Between 1920 and 1930, total residential mortgage debt in the country tripled. Savings and loan associations alone financed 4.35 million properties, totaling more than $15 billion in loans. Homeownership climbed through the decade, peaking around 47.8% by 1930. More people than ever were buying homes, but the underlying structure was as fragile as before. Balloon mortgages, short terms, and interest-only payments were still the norm, and borrowers were taking on debt that was increasingly large relative to both the purchase price and their own income. One historian later described the lending landscape of the era as a crazy quilt of land contracts, second and third mortgages, steep interest rates, short terms, balloon payments, and other high-risk practices. A house of cards, with everyone betting the wind wouldn't blow.
It blew in October 1929 when the stock market crashed, triggering the worst economic collapse in American history. The damage reached deep into the housing market. Banks began failing by the thousands. More than 9,000 had shut down by 1933. And as they went under, they took the credit system down with them. Lending dried up almost entirely. Jobs vanished. Unemployment surged past 25%. And homeowners who had been keeping up with their interest-only balloon mortgages suddenly couldn't.
The scale of the fallout is staggering. By the spring of 1933, roughly 1,000 families a day were losing their homes to foreclosure. By 1932, about 250,000 households had already been foreclosed on. A year after that, half of all mortgages in the country were in default. It was a self-feeding spiral. Defaults sank banks, and sinking banks meant even less credit available, which produced still more defaults. Building and loan associations, the lifeline for working families, were caught in the same storm. More than a third of the roughly 16,000 such institutions nationwide were pulled under as the commercial banks they depended on for extra funding collapsed. Credit lines vanished, and panicked members rushed to withdraw their savings. The national homeownership rate, which had peaked at 47.8% in 1930, sank to an all-time low of 43.6% by 1940. The dream of owning a home in America was sinking with it, and no one had yet figured out how to save it.
That's when the federal government did something that would have seemed unimaginable a decade before. It intervened directly and permanently in the housing market, building the finance system Americans still use today. The first move came from President Herbert Hoover, often remembered as passive during the Depression, though he did push some structural reforms. In 1932, he signed the Federal Home Loan Bank Act, establishing a network of 11 regional federal home loan banks modeled on the Federal Reserve, but focused specifically on mortgage lending, meant to act as a backstop of liquidity for savings and loan institutions. It helped, but it wasn't enough to stop the bleeding. The real turning point came in 1933, when Franklin Delano Roosevelt took office and launched the New Deal. On April 13, 1933, Roosevelt asked Congress for legislation to shield small homeowners from foreclosure, and lawmakers moved with unusual speed. On June 13, 1933, they created the Homeowners Loan Corporation, HOLC. Rather than lending directly to homeowners, the HOLC bought up defaulted or foreclosed mortgages from banks and other lenders, paying them in government bonds, and then refinanced those troubled loans on far more forgiving terms, converting short-term balloon mortgages into 15-year, fully amortized loans at interest rates around 4.5%.
For the first time, struggling homeowners could make monthly payments that actually covered both interest and principal, spread across a period long enough to be manageable. By the time the HOLC stopped issuing new loans in June 1936, it had purchased and refinanced more than 1 million mortgages, worth over $3 billion, saving hundreds of thousands of families from losing their homes in the process. it proved something essential. Long-term, fully amortizing mortgages worked. They were safer for borrowers and steadier for lenders.
But the HOLC was always meant to be temporary triage. What the country needed was a permanent structural fix, and that arrived in 1934, the year everything changed. On June 27, 1934, Congress passed the National Housing Act, creating the Federal Housing Administration, FHA. This is the moment the modern American mortgage was born.
The problem the FHA was designed to solve was straightforward. After the Depression, lenders were terrified to lend again, having already lost fortunes on defaulted mortgages. Credit had effectively frozen. At this point, only about 1 in 10 Americans could afford to buy a home under existing terms. The FHA's fix was for the federal government to insure mortgages against default, so that if a borrower stopped paying, the government, not the lender, absorbed the loss. That guarantee gave banks the confidence to lend again. But the FHA didn't just insure the same old balloon loans, it rewrote the rules entirely. FHA-backed loans had to run long-term, starting at 15 to 20 years, later stretching to 25 and eventually 30. They had to be fully amortizing, so every payment reduced the balance, and the borrower owned the home free and clear at the end. Down payments dropped to a range of 10 to 20%, a massive change from the old 50 to 60% standard. And interest rates were fixed, giving borrowers certainty about what they'd owe every month for the life of the loan. It's worth noting that the 30-year term specifically didn't appear all at once. The FHA started with 15 and 20-year loans and gradually lengthened them. Congress didn't formally authorize 30-year mortgages for new construction until 1948, or for existing homes until 1954. And even then, adoption was gradual. Average loan terms in the late 1940s and early 1950s were still around 21 years. The 30-year mortgage didn't become the dominant standard until the 1960s, but its roots trace directly back to the 1934 framework. The FHA alone still wasn't a complete fix. A bank issuing a 30-year loan had its money locked up for 3 decades, unable to use that capital for new lending, a bottleneck that could choke off lending supply all over again. So in 1938, the government created the Federal National Mortgage Association, Fannie Mae, to build something new, a secondary mortgage market. Banks would originate loans. Fannie Mae would buy those mortgages from them, freeing up fresh capital for the banks to lend again. And Fannie Mae would either hold the loans or package and sell them to investors. It created a continuous loop of capital, from investors, through Fannie Mae, through banks, to home buyers, ensuring the well of mortgage credit wouldn't run dry the way it had during the Depression. It was, in effect, an interstate highway system for money, linking local lending markets into one national network. Post-war boom and Levittown. Then came World War II, and its end in 1945 sent millions of veterans home, eager for stability and a place of their own, right as housing stock, starved by years of wartime construction freezes, fell drastically short of demand. The government's answer was the Servicemen's Readjustment Act of 1944, known as the GI Bill, which offered veterans home loan guarantees with little or no down payment and low interest rates. A returning soldier with essentially nothing could walk into a bank and, backed by the federal government, buy a house without putting a dollar down. The results were enormous. By 1955, 4.3 million home loans had been issued through the GI Bill program, worth a combined $33 billion, and veterans accounted for 20% of all new homes built after the war. Demand on this scale created entirely new kinds of housing development. In 1946, the firm Levitt & Sons bought 4,000 acres of former potato farmland on Long Island, New York, and began mass-producing homes using assembly line construction methods, identical Cape Cod-style houses rolling out at industrial speed, selling for around $7,000 each, or about $29 a month on a government-backed loan. Levittown became the template for the American suburb, and it was replicated coast to coast.
The homeownership numbers tell the story plainly. In 1940, at the Depression's tail end, only 43.6% of American households owned their homes. By 1950, that had risen to 55%. By 1960, it hit 61.9%. In just 2 decades, the country flipped from a nation of renters to a nation of homeowners, a pace of change that has never been matched since. FHA insurance, VA-backed GI Bill loans, Fannie Mae's secondary market, the fixed 30-year mortgage, mortgage interest tax deductions, and a roaring post-war economy combined into an unprecedented wave of homeownership.
The darker legacy. That story isn't all white picket fences, though. The very system that opened homeownership to millions of white Americans simultaneously locked it away from Black Americans and other minorities. And the roots of that go back to the HOLC itself. In the late 1930s, the HOLC produced residential security maps for major cities, grading neighborhoods from most to least desirable and color-coding them accordingly. The safest were marked green, the riskiest red. The grading wasn't a neutral financial judgment. It was systematically racial. Neighborhoods with significant Black, immigrant, or minority populations were routinely marked hazardous, regardless of housing condition or residents' actual creditworthiness. This became known as redlining. The FHA adopted these maps to guide its own insurance decisions, refusing to back mortgages in redlined areas. The VA did the same with GI Bill loans, and private lenders followed suit. The effect was to systematically exclude Black Americans from the greatest wealth-building program in the country's history. The numbers make it stark. In 1947, only 2 of more than 3,200 VA-guaranteed home loans issued across 13 Mississippi cities went to Black borrowers. In the New York and northern New Jersey suburbs, fewer than 100 of 67,000 GI Bill-insured mortgages supported home purchases by non-white families. Developers like William Levitt openly refused to sell homes in Levittown to Black families. The suburban dream was, by design, a whites-only dream, built and enforced with the backing of federal financial institutions. This is among the most consequential injustices in American economic history, and its effects haven't gone away. The racial wealth gap in the United States, where the median white family holds roughly 10 times the wealth of the median Black family, traces directly back to these housing policies. While white families built equity in homes that appreciated for decades, Black families were largely locked out of ownership, confined to redlined neighborhoods where values stagnated, lenders refused to invest, and the path to generational wealth was systematically closed off. A uniquely American invention. Stepping back, the 30-year fixed-rate mortgage is often treated as a mundane piece of paperwork, but it's actually one of the most radical financial inventions of the 20th century. It transformed the United States from a country where owning a home was a luxury into one where home ownership became the primary engine of middle-class wealth. It fueled the suburban boom that reshaped American cities, highways, schools, and retail, and it built an entire financial ecosystem, from Fannie Mae and Freddie Mac to today's trillion-dollar mortgage-backed securities market. It's also a distinctly American product. Most other countries never adopted anything like it. In Canada, the standard mortgage term is 5 years, with loans rarely extending past 10. In the United Kingdom, fixed-rate periods of 2 to 5 years are typical before the rate turns variable. Across much of Europe and Asia, shorter-term adjustable-rate mortgages dominate. The fully amortizing 30-year fixed-rate loan is a product of a specific American catastrophe and a specific American government response. Without the Depression, the New Deal, the FHA, Fannie Mae, and the GI Bill, U.S. housing finance would likely resemble the rest of the world's far more closely. Yet the system built in the 1930s isn't without risk. The same features that make the 30-year mortgage appealing, low monthly payments, a long time horizon, government backing, can turn dangerous when pushed too far. That played out again in 2008, when the housing market collapsed in a way that echoed the 1930s.
Lending standards had loosened dramatically. Mortgages were handed to borrowers with no realistic ability to repay them, and those loans were bundled into complex securities sold worldwide. When defaults hit, they nearly brought down the global financial system. Fannie Mae and Freddie Mac, the very institutions built to stabilize the mortgage market, had to be seized by the federal government in September 2008 to prevent their collapse, at a cost to taxpayers running into the hundreds of billions. It was a sharp reminder that the system born in the 1930s, transformative as it was, isn't self-correcting. It demands ongoing oversight and a recognition that housing isn't just a financial asset. It's where people build their lives, raise their families, and form communities. And it remains the single largest purchase most Americans will ever make. So, the next time you sign mortgage paperwork or make a monthly payment, it's worth pausing on how improbable the whole arrangement really is. It's a financial system barely a century old, born out of the wreckage of the worst economic disaster in American history, engineered by officials scrambling to keep homeownership from collapsing entirely. Before them, buying a home meant being rich enough to pay cash, bold enough to gamble on a balloon mortgage, or fortunate enough to have a building and loan nearby. The idea that an ordinary person could walk into a bank, borrow money for 30 decades at a fixed rate, and steadily pay it down while living in the home, that idea simply didn't exist. It had to be built. And the fact that it has worked for tens of millions of families across nearly a century is one of the more remarkable achievements in American economic policy. But it's also a system built with real flaws. Flaws that shut people out because of the color of their skin. Flaws that reckless lending has exploited before. Flaws that are a reminder that even transformative institutions need constant repair to keep serving the people they were built for. The 30-year mortgage isn't a law of nature. It's a human invention. And like every human invention, it carries both the brilliance and the failures of the people who built it. If this story changed the way you look at your own mortgage or your own home, let me know in the comments below. Which part surprised you the most? The balloon payment trap, the building and loan associations, or the darker legacy of redlining? Hit like if you want more deep dives like this one. Share it with someone who's ever signed a 30-year loan, and subscribe so you don't miss what's coming next. Because the story of how America built its wealth, one house at a time, is far from over. See you in the next one.